Good morning, traders. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. And for this edition of Trade Talks, we are going to look at one of the more common strategies options traders employ, and that is called the debit spread. You can use it either as a bullish position or a bearish position. And joining me is Tony Zhang. He is the head of product strategy at Options Play. Tony, as always, thank you for joining me at MarketSite. And today we want to discuss some best practices that can be used for debit spreads, whether bearish or bullish.
So debit spreads are actually one of my favorite strategies. It can be deployed for both bullish or bearish directional views with limited risk. It's great because you can use it for bullish or bearish with in both high and low volatility environments. And traditionally, if you were bullish on a stock, let's just talk about call spreads for one second, you would buy a call. With a bullish call spread, what you're doing is you're buying, let's say, a 100 strike call, and you're also selling a higher strike call against it, a 110 strike call. And what that does is it brings in a small credit, and that goes against paying for the cost of the long call, which lowers the cost of the trade, it lowers the break-even price of your strategy, and it just limits the amount of risk that you're taking, or lowers the amount of risk that you're taking on that specific strategy. What that means is that it requires less capital to get into a debit spread compared to just buying a call, and it requires a smaller move in the stock in order for the strategy to be profitable. And lastly, because you're short that call leg, that also means that time decay is working in your favor on that short leg. So the time decay that you're receiving on the total strategy is actually slightly smaller, which means that it's a little less time sensitive when it comes to trading a debit spread compared to just buying a call.
Right. Well, let's look at NASDAQ listed Celgene as an example for a bullish strategy that you can use purchasing a call spread.
Yeah, so Celgene's a great stock. It's a healthcare stock, which is a very strong sector right now. It's been trading between 110 and 130 for quite some time and recently just broke out above that. So I was looking at the September 130, 145 call spread, which is trading around 550 right now. Gives you a great way to take advantage of a bullish move on Celgene with limited risk.
All right, now if we look at it from a bearish perspective, this is where you would buy a put spread. Would you manage the position the same even though you're using puts versus calls?
Exactly.
Right.
You would use the exact same way. So instead of buying an at-the-money call, you buy an at-the-money put, and then you would sell a lower put against that. And for beginners that are in this strategy, I usually tell as a good starting point is to buy an at-the-money put and sell about a 15 or 20 delta put against that. And it works the same way for calls as well.
Right. And for a bearish strategy, we were looking at KMI as an example in the energy sector, which has had some issues with oil trading where it is.
So energy is still continuing having troubles to stabilize and recover. So KMI is one of those stocks that we're looking at that just broke below that 1950 support level that's been holding for almost 2 years now. And we're looking at the August 20 by 18 put spread, which is trading around 80 cents right now, which is a great cheap way to potentially play earnings, which are next week on KMI.
All right, so let me ask you a question. When you have a spread versus just buying a call or a put, it's true that the upside is capped because you're selling that downside protection as well. Just your personal trading style, do you prefer to trade spreads versus straight calls or puts for that reason?
Absolutely. So the downside or the limitations of spreads is that you're limiting that upside. However, when you're trading these strategies, you generally are not expecting the stock to make giant moves. So the benefits of having lower amount of risk, a smaller amount of capital in order to trade them, and a lower break-even price greatly outweighs limiting that risk above a certain price. So it really becomes an exercise in figuring out what is the strike price that you sell. So like I said, as a rule of thumb, if you're a beginner to this strategy, you want to sell about a 15 to 20 delta call, which has a relatively low probability of the stock hitting that price.
All right. Well, thank you very much, Tony, for joining me as always at the MarketSite and Twitter. Thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.